I one time in Florida, I had it was ghost peppers and watermelon
Ooh,
margarita.
that sounds delicious.
So it was a frozen watermelon. It was ghost pepper. Boy, it was spicy and it was good, but whew, it was out of some place on St. Augustine,
Yeah.
especially the house. And boy, they were good. But
Hey everybody, and welcome back to today's Tech Talk Tuesday from MarketEdge.com. With me today is resident expert David Blake to discuss last week's market letter and address a question from a listener. David, how are you today?
I'm doing well, thank you.
Great, let's get into it.
All right, well, we're back into summer rally mode after we had a little bit of a pullback on the week of July 4th. We reversed things last week. We kind of kicked off things, which was a little bit surprising to me, that I actually thought that investors in the market might be a little bit cautious going into the CPI and PPI, as it seemed like the economy was doing pretty well in June. I thought that might, keep up a little bit upward pressure on the pricing. But like I said in the letter, they threw caution to the wind. We started off, the Dow scored 526 points on Monday and Tuesday. That's 1.5% before the CPI came out. And once that came in, it was kind of a surprise. It was much lower than what we thought it was going to be. And despite Fed Chair Jerome Powell coming out in the afternoon or later on that day and saying that we still have a lot of work to do, and we're probably still going to raise rates at least one more time, maybe two. The market took off again. We did see, actually that CPI was the smallest 1 month increase since August 2021. So we're seeing some strong progress here on the inflation front. And on Thursday, we had the producer price index, the PPI, and the core-PPI, which the Fed usually looks at that a little bit stronger than the regular headline numbers. It was only up 0.1% and 2.4% year over year. Now the CPI is a little bit more important, but the producer price index is what if it's going up, then the end prices are going to have to move up. So that's getting close to what the Fed's target rate. So investors cheered that data. Then we also had, despite the rates going up, we actually had a drop in initial jobless claims. I think they fell about 15,000. So that was better than anticipated. And normally when you have the jobs data getting too strong, in the past it was a bad sign because investors or market participants basically thought that meant that the Fed is going to have to pull things, just keep raising rates. But now with the inflation data slowing and cooling off here, the fact that we're still hanging in there around 250,000 initial jobless claims a week means that it's just add more insurance. I think that the odds of us going into a recession are lighter, and it's actually kind of good for the market right now. With that data came out, we had yields drop on the 10-year Treasury. I think they got down as low as 370, which is where they are today. And then I think it closed on Friday at 382. And the 2-year T-bill rate fell all the way down to 4.7, and that's down from 5% just about 10 days ago. So we are seeing rates start to move lower. We still have about a 98% chance of the Fed raising rates a quarter of a point. I don't think it's going to make any difference next week when we get to the FOMC meeting. That's kind of built into the market right now. As far as the rally went, it was broad-based again. It keeps broadening out, which is what we want to see as technicians and investors. We had the growth sectors of consumer discretionary, communication services, technology, materials. They were all up more than 2.5%. We did see crude oil prices nudge up to a 10-week high, and they closed at 75.31. Now we've had 2 days where oil prices have pulled back a little bit. Part of that is because yesterday we had we had the GDP data out of China, which was 6%, which still is not bad. but they were projecting 7%. So we continue to see that China's reopening bogged down a little bit and get slower and slower. Part of the regime thing going on over there. But as long as we see that, we'll have to see what's going on with that. And that's falling down the last 2 days, despite Russia and Saudi Arabia both saying they're going to cut production. I'm not sure why Russia's doing that, but they say they're going to. But anyway, so we're starting to see a little bit of a pullback in crude oil prices this week. Last week, one of the things that did raise that helped push prices up was a weakness in the U.S. dollar. You know, most all commodities are tied to the U.S. dollar, and when the dollar gets weaker, usually commodity prices will move a little bit higher. That's actually good for emerging markets, but that's something to keep an eye on. You want to keep an eye on the U.S. dollar. It's also good for our stocks. When the dollar falls, that means our goods are cheaper for overseas and all. So anyway, we started out on Friday. We had the money center banks beat expectations. It's kind of traded mixed. We had J.P. Morgan had a great report, but then I think Wells Fargo and Citigroup were kind of mixed, and they were good, but they didn't blow it out of the water like J.P. Morgan did. Then we had State Street and some of the other regional banks. I guess it's the cost for deposits and that kind of thing. Expenses were going up, which I saw State Street drop, I think, something like 10, 11, 12%. And then we had the KRE, which is the regional banking ETF. It was down 1.5% on Friday. So the regional banks are having a little bit more of a problem. Today we had Morgan Stanley and Bank of America came out. Their numbers were great. It seems like the bigger the bank, the better their earnings are going to be, and the more they've cut back on that. Morgan Stanley is up about 5 or 6% today, despite having lower trading volume, which I guess that's okay. They're just not seeing a lot of new issues coming out, but they do see more coming out during the year. That helped the stock out there. They also saw a lot more money coming into some of the managed funds. Because of that, we saw a big, I think Goldman Sachs delivers earnings tomorrow. And because of the success that Morgan Stanley had, we have Goldman Sachs up today, up 3.2%. So that's strong. Morgan Stanley's up right now 6.3%. So again, they kind of blew out expectations. That's good, I guess, for the bigger banks and stuff. We have Schwab coming out. I think actually Schwab came out today also, and they beat earnings. So that stock has gone up pretty significantly too. So earnings are coming in. A lot of times we say better than feared, but they're actually, we didn't see the numbers getting cut too badly going into in the second quarter here, which is good. And they're actually the companies are actually still beating the numbers. I think May and June, especially June, is turning out to be a stronger business month than what they anticipated. Okay, the technical condition of the market, it did improve last week. It looks strong again this week. We have the NASDAQ and S&P 500 are up at 15-month highs today, and we'll take a look at this chart in a little bit. We have the Dow Jones is up 359 points as we speak, and it's breaking out of its sideways trading range. We've had Rachel, go ahead and go to the charts just for a minute. This is pretty big. And I want you to pull up the DIA on the charts. This is the ETF for the diamonds. And as we've talked about throughout the year, you can see going back over here towards December of last year, after coming off of that October low, we had a big spike up when it looked like, I was going to be into the rate hikes and blah, blah, blah. And, that was, things were looking good. Then you can see it's been kind of a sideways, market for the diamonds and Dow Jones Industrials. You can also see kind of a reverse head and shoulders, which is, as we're breaking out of that, looks like, we could probably go up another 2,000 points from that neckline. But anyway, today with this 359 point gain, 365, it's going higher as we speak. You're really breaking out of this sideways trading range that the Dow Jones has been in, and that's a big deal, to tell you the truth, because you have this market. They go along sometimes. They'll find themselves in a trading range for several months, 6, 7 months, something like that. And then when they break out, you're usually going to have a big target. And we'll talk a little bit more about that because it looks to me like there's an outside chance here that we could actually see the major averages actually go to new highs here. We'll have to see about that. But anyway, we did finish last week with several of the indexes a little kind of overbought. We had the RSI on Wednesday and Thursday last week of several of them that moved above 70. You don't get up that high very often. I think the net QQQs were up around 75, which was the most that have been overbought since I think 2020 or something like that, 2021 when we made a new high. We also had the S&P, the MarketEdge S&P short range oscillator on Thursday of last week up to 574. That's overbought. When it gets up around 7, we found that you're usually going to see the market maybe pull back a little bit. But around 5 3/4, it wouldn't be surprising to see some consolidation of these recent gains here. So we'll kind of watch that, let the overbought condition work itself off as we go into earnings in here. We also saw the secondary indexes, which I like to see lead the market higher and lower. They continue to outperform the big three. We had the Dow Jones Transportation Index hit its highest level since April 22 last week. We had the Semiconductor Index, the SOX. It was just a chip shot from a new all-time high. It may be getting to that today. Let me see something here real quick. No, today we're pulling back a little bit, but the semiconductors are almost at an all-time high, which is something you want to see. I think that's going to continue. And we also had technology, industrial, as far as the sectors go. They were making new highs. Growth sectors, communication services, and consumer discretionary. They traded up to their April highs. They're moving higher again yesterday and today. So it was a strong week. Yesterday we had some nice gains in the market. Nothing big, but just still kind of nudging up a little bit higher. Yesterday we had the growth sectors once again outperforming, and we started the weakest sectors were actually the defensive and rate sensitive sectors like utilities, consumer staples, REITs, healthcare, that type of thing. They were the weakest ones yesterday, and they're weak again today. Underlying breadth last week was good. It was strong. We keep talking about for this rally to continue into the end of the summer. We need to have more participation, and we've been getting that the last 6 weeks or so. The AD lines for both the NYSE and NASDAQ are moving high. The NYSE AD line is almost at a new high. That's good. New 52-week highs are outpacing the new lows and expanding by considerable amounts. Something like, I think last week one day we had on NASDAQ one day we had 272 new highs and 47 new lows. So that's something you want to see. That means it's we're no longer the Magnificent Seven or whatever they call it is still leading the pack. You are seeing broader participation. You have almost 300 new highs. You're having a lot of stocks up there making new at the top of their range. Today with this range, with the Dow up 350 points, you actually have the NASDAQ down a little bit. You are seeing some profit taking going on in the big cap technology shares, but I don't think of that as a broad. If you're trying to sell these things, they're having a restructuring of the repositioning or weighting in the QQQ, which is the NASDAQ 100. And so what they do, what's happened is some of these, Microsoft, Apple, and NVIDIA, some of these stocks, their weightings have become too much. I think they don't want these things to have more than like a 7% weighting in the index, or maybe less than that. And so what they've had to do is the index itself is having to shed off some of these stocks, the big cap stocks that have gotten too big, and that's why you're seeing the underperformance in that. You have the NASDAQ and the QQQ both are down. Nothing big, less than 0.5%, but that's why you're probably seeing some of this weakness in that group of stocks. So I'm not worried about that. As far as investor sentiment goes, we're seeing, they're still bullish. We saw I saw a little bit of a pullback in the numbers, but these surveys come out a little bit early. I think you probably had some investors back off ahead of the CPI and the PPI last week, and maybe earnings. Just you had the retail investors after reaching a one-year high the week before, 46.4% bullish, fell back to 41, and then the percentage of bullish investment advisors slipped back to 51.4 from 55 the week before. Now, the one group that did go a little bit more bullish was the hedge funds. Their exposure index jumped up to 93.3. That's the highest exposure to equities that they've had, the hedge funds, since November of 2021, which is right before the NASDAQ topped out. It topped out, I think, the last week of November 2021. So that's something that it's good. When they reach extreme levels, sometimes you can look at them as a reason to be a little bit cautious. That means if everyone's overly bullish, that means there's not enough money to chase stocks any higher. That's why they consider that contrarian. It's not a reason to sell stocks, but it would just be, if we start seeing the hedge funds going into on margin, that type of stuff, it would be a little bit of a red flag. As far as momentum goes in the market, it's staying positive up here at +8. Again, breadth was strong. We had the AG line, the NYSE gained 3,700 units. As far as what's hot, we had of the 91 industry groups we have 70 are rated either strong or improving, and only 21 regarded as weak or deteriorating. So, the market looks good. I think it's possible that we could see some consolidation as we stay up around the overbought range, but I do think that earnings appear to be coming in a little bit better than what they hoped for, which could could also help to broaden out the rally. And I think that right now you're in good shape. I don't know that I would be chasing things up here and loading the boat on stuff in here. Hopefully you're 70% or so, or 75% invested right now, and I would certainly recommend keeping what you have, and let's just see how far we go. And as I mentioned last week, the CPI we changed our posture to neutral, and we're doing some reconfiguring on that, because again, that's kind of it's a forecasting tool, and when you're forecasting a market, it's not going to be something where you look at the numbers and then it's something that we can continually adjust, and maybe we can talk a little bit about that later on. But for right now, things look good, and I think that you're going to see some upside surprises with this end of earnings coming out here in the second quarter. And again, the economic data continues to show a resilient economy. And in fact, I think it was Goldman Sachs today said they see only about a 20 to 25% probability of a recession coming at the end of the year. So right at this stage, things look pretty good.
Great. Well, thank you so much, David. And as you alluded to, we do have a question about our CTI and market posture. John asks, what are the implications or inferences to be drawn when the market posture is bearish and the CTI is negative, relative to suggesting going long or short on stocks? How does that affect our recommendations? Can you speak to that a little bit?
Yeah. Okay. The CTI, it stands for Cyclical Trend Index, is it's one of the cornerstones of what MarketEdge does. Back years ago, a man's name is Hurst, Hurst. He was a PhD who discovered all their underlying cycles or waves in the markets. And if you look at these, they're kind of like sine waves going throughout the market, and they go in different different wavelengths. We actually look at 5 of them. You can go down as low as even 1 day if you really dig into this stuff. But they exert upward and downward pressure on the market is what he found out. The bottoms are usually very easy to identify. It's harder to pick out when the tops are reached. But this is something it's kind of more like an art form. The longer you study it, the more you can do it. So the second opinion is a trend following model. It's whereas the CTI is a forecasting model. So that's how they're different. When we go into when the CTI goes negative, that means that you have more, especially if you have, if you have like 3, if you look at on the edge, which comes out monthly, we try to put the cycle lengths in there and where we are in their progression. If you're seeing like 3 or 4 cycles all of a sudden go negative, that's exerting a lot of negative pressure on prices. And then if you look at your second opinion, it's picking up the fact that the trend is lower, and that you're better off shorting, finding stocks to short during those periods than you would. I mean, right now I wouldn't be looking the short stocks in this environment. Like we saw there with the Dow Jones. I mean, you're breaking out of a 7 month trading range. You're breaking out to the upside. Why would you want to short it? I know some people go, oh great, now we're overbought. Let's short something. Stocks in the market stay overbought for a reason. It's because people like it and they're jumping in there to buy it, so they can stay overbought for quite a while. It's not always overbought. It's going to pull back. It may pull back. It could take months before it does that because market participants like what's going on. That's why they're buying it. So just the fact that you have NVIDIA jumping up by 200% this year, but the market still is strong. It's not just NVIDIA. You're not looking to short NVIDIA in here. I mean, you may get lucky and pick up a couple of dollars, but if we're bullish, the positive bullish, you're looking for stocks that are that the 50-day relative strength is above 1, and you're looking to buy those. Sure, you may find something where you get a headline where something's going out of business we're bullish on everything, where you might get a short like that. But just in general, you're not looking to be shorting stocks in here because you're stepping in front of a freight train. You don't want to do that. Now, again, when we maybe in September, as we start to see the cycles that are all heading up now, as they start to turn down, maybe at that time, after you've had this big run up in the market, the NASDAQ's up 25% this year, 30%. That's a heck of a move. So maybe you get a 7 or 8% pullback in the NASDAQ or some of these. So at that stage, as we flip over back into a negative or bearish market posture, okay, then you start to look at the second opinion and go, okay, well, the market posture is bearish. Her cycles here say that we probably are going to put in a bottom at some point, and we took out the previous week's low. Then you start looking, okay, what stocks are trending down? Which ones are trending lower? And those are the ones that you want to start to look at shorts. And the second opinion will tell you that. Now right now when you're bullish, some of them say stocks are short sale candidate. Well, that's you roll the dice and take a shot on that. But as they say, when a rising tide lifts all boats. So sometimes when I talk to you sometimes about buying, you want to buy the strongest sectors, and you want to find the strongest industry groups in that sector, and then you want to find the strongest stocks in that industry group, well, you can buy a great stock, and and if you're in the right groups, even if you buy a second or third tier stock, you're going to make money. You can buy a great stock in a negative industry group or sector. Like right now, I'm not sure you want to be buying the real defensive stocks, like things like utilities and that kind of stuff. Where you could buy a great utility company, but if the market is if that industry group is negative and going lower, that's you're not going to make money on that with that stock anyway. So if you're in the wrong sector, you're not going to make money, no matter how good the company is. That's just the way the market works. So the big money is moving on to where they want to get in the strongest areas. So that's how I would recommend taking a look at that. To use the second opinion to find the stocks that are trending in the same direction as the CPI is pointing. That should help you with some of your picks and your stuff. You can also look at that with your, you have your, if you have all your stocks that you're following or that you own in your stock watch lists and you see that we're changing going from a bullish or neutral to a bearish posture. You start to look at some of those stocks, and as they fall below 1.0 in the 50-day relative strength, that means not only are they starting to go down, but they're also underperforming the market, and those may be ones that you probably want to get rid of or maybe short. One other thing I did want to mention is if you go up here in the right-hand corner up there where it says Manage on your MarketEdge page that we're on right now, go ahead and click on that. If you go to the Help Center, click on that. Okay, over here on the left it says Market Letter and On the Edge. We have 5 articles in there, and one of them is Market Timing in the MarketEdge CTI, and it will simplify what I've tried to explain here, and it will go over, has a couple pages on there, and it talks about the different cycle lengths and how we determine what's going on, and it'll also explain if you go to some of the other ones, it'll explain how we don't just rely on the cycles. We throw in the sentiment index and the momentum index to kind of back up where we're going with this thing. In other words, just because we think maybe we've seen a bottom in the cycles and we're going to go bullish, well, that momentum index is telling us that, hey, we're at -4. You got the Dow Jones is outperforming everything. The secondary index is still going down. We're not going to flip that over into a bullish market posture until we get confirmation.
Great. Thank you so much, David. We appreciate that explanation and some insight into our market indicators here. So if anyone has questions for David or anyone else on the MarketEdge team, feel free to reach out using that Chat Now button in the bottom right-hand corner, or send us an email at support@marketedge.com. As always, your first 2 weeks are free at marketedge.com, and we'd love to see you. All right, we'll talk to you guys next week. Thanks, David.
Bye-bye. Bye-bye.